I just watched a founder turn down $8 million and it was the best decision that he's ever made. So you want to sell your software company. You've come to the right place. I've helped close over $250 million in acquisitions working at Robinhood, Rackspace, and PwC. This guide is going to cover exactly how to calculate your exit valuation, how to sell your company, how to find buyers, and how to get started tonight so you can make moves and make some money. But first, matcha break. All right, we're going to get started with valuation. So how much is your business going to sell for? We can find out in just 5 seconds. So you can go ahead over here and click Find My Valuation. Links in bio. You guys can use this tool for free. You're going to see we can enter our monthly recurring revenue. So this is your last month's revenue. Your annual EBITDA. So this is your profit over the last 12 months. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. But in the world of investors and buyers, EBITDA is thought of as profit. So you can just enter your last year's profit here. And then your annual growth rate. Just take what your revenue was 12 months ago from today and calculate your growth rate. So we can run our valuation here. Based off of a business doing $50K a month in revenue, that's profiting $200K a year, so $600K annual sales, $200K in profit, that's growing 30% a year, our software business has a valuation at about $3 million. You're going to be able to adjust your growth rate. So if you are more conservative, if you think that your business is going to grow closer to, let's just say, 15%, you could see that the valuation range shifts down to in between 1.7 million and 2.8 million. Whereas if you kick it up and you think the business is going to grow a lot more aggressively, closer to 60% for this next year, your business could have a valuation of in between 4.3 million and 7.5 million. So right below the growth rate slider, you're going to see a breakdown of the first type of valuation. This valuation is called discounted cash flows. And what that means is it takes your free cash flows from each year, which is based off your profit, and it discounts those cash flows back to today based off the time value of money and the cost of capital, or the opportunity cost relative to the reward that they're getting for the risk in your industry. So to explain that in a different way, the investor is assuming that there's a certain risk percentage associated with getting those cash flows. That's all that it's saying, and that's the reason why $10 million, 5 years from now isn't worth as much as it is today. So what that really looks like down here is we project our revenue over the next 7 years. So based off whatever data that you have, your historicals, however much money you're making a month, is going to take that, it's going to take your growth rate, it's going to project all of your cash flows over the next 7 years, and then it's going to compile everything. What is the total amount of profit that your business is going to make over the next 7 years? And then after 7 years, it's going to project how much your business is going to make at a much slower rate of growth that is called the terminal value. Okay, so down below, you are going to see this table is called its sensitivity analysis. So it's going to project out a few different scenarios. We just talked about the discount rate, which will range. A lower rate means your industry is less risky, so your business is going to be valued more. And then a higher rate means that your industry is more risky. On the y-axis, there's the terminal growth rate, which is just the assumption of how fast your business is going to grow when it's at a stable state and it's no longer a startup or a rapidly growing company. So in this valuation model, we are assuming that your business is going to grow quickly over the next 7 years. In this case, starting at 60% and then ratcheting down to about 2%, which matches inflation. And then at that point, your business is just going to grow at the pace of the economy. Some of these estimates and the ways that the rates scale down are a little bit more conservative. And the reason why is because your valuation range will likely be higher than what it is using my valuation tool. Okay, so that's the first form of valuation. It's called discounted cash flows. Now, the second form of valuation is called comparable multiples. And what it's based on is very, very simple. there's two variables. There is the amount of money that you're making in a year, and then there's the amount of money that you're profiting in a year. And based off those two numbers, you're going to see two valuation ranges. So in between 1.8 and 3.6 million in this example is based off the ARR, the annual recurring revenue. And then for our EBITDA or our profit, the multiples are giving us a valuation of in between 800K and 2 million. So you can obviously notice this, but when an investor is choosing to price your business based off the profit, you're going to get a cheaper valuation as opposed to being valued based off the revenue. So use this tool, and then you're going to have an accurate range where you know how much your business is worth. And you're going to use this to go and find buyers. All right. All right, guys, let's get started looking for a buyer. So the process of selling your company is just going to take a few key steps. First is preparation, then is going to market and looking for buyers, then is receiving offers and negotiating, then is structuring the deal, closing it, and moving your money to the bank, right? So let's get really tactical here. To prepare for selling your business, you need to collect all of your financials. So your monthly recurring revenue, your annual recurring revenue, your EBITDA or your profit, your monthly churn, your cost to acquire the customer, and your lifetime value in a customer. So you can export wherever you keep your financial data and your payments, probably Stripe, QuickBooks, or Plaid. Based off all that information and the story of your business, you want to take your financials, you want to take the problem you're solving, you want to talk about the market a little bit, which customers you have, you want to bring all that information into an investment memo. This is going to be a short PDF in between 1 and 3 pages that you can send to investors and potential buyers to try to market your business for sale. I also recommend, as early as you can, set up something called a data room, which is basically just a small part on the internet where your company's files live. So potential buyers who are interested in kicking the tires and learning about your business can go somewhere where the sharing and permissions have already been figured out, and they can just jump in and look at your financials, your legal documents, whatever they need to know to make a decision about buying your business. Now that we have everything set up, we have our financials, we've created an investment memo, and we have a data room where our files are uploaded to, we can now build our buyer outreach list. So once again, link in bio. I've already put together one for you guys based off my experience in the industry, some software, private equity funds, and investors that buy software companies like yours. Once you have this list, right, you want to start doing outreach. Outreach is very important, but a lot of people overcomplicate it. What you really want to do is just create a subject line between 1 and 2 words that really quickly talks about your business, what kind of customer you serve, and how profitable or how much money you're making. So for example, if your business is doing 6 million a year in revenue and it's profiting 4 million, you could just say 6 million ARR dash 4 million EBITDA. You have that subject line. Beneath that subject line, you want to write just a little bit of information about your business. You want to research the person, personalize it a little bit. Now that you've sent out your emails, you're going to start getting responses and setting up conversations with these buyers. These are called qualification calls. You are going to be qualifying them as a buyer, and they're going to be qualifying you as a target company that they're acquiring. So most of them are going to want to dive deep into your financial statements. They're going to want to talk about your product, your customers, if you're churning anyone away, why you created this business, what your industry background is, all these kinds of questions. Once buyers have moved past this initial qualification phase and you actually know that they're interested in buying your business, you can now begin to send NDAs, get the buyers to agree to confidentiality on your business, and then you can focus on actually selling them on why your business should be bought. Now that you're meeting with some of these potential buyers and they've signed an NDA, you're going to be able to share confidential information with your business, which is going to prompt the buyer to want to give you an offer, right? This is tracing back to before. This is why we calculated a rough valuation range for you. Now that the buyers are starting to field offers for you, you're going to have an idea of what your business is actually worth based off of the performance of your company, from the free cash flow coming down from your EBITDA or your profit, and what other investors are paying for similar companies to yours, which is the comparable multiple valuation. So you have both these valuations now in your back pocket for evaluating the offers that you're getting from investors. Based off the investors and the buyers that have the highest ranges that they're willing to offer to buy out your company, you want to run a few competitive conversations. What that means is, instead of talking to any buyer that is sending you an offer, you're going to just limit it to the most credible, highest valued offers. This is going to save you a lot of time in the process. Now, once you've identified who those competitive conversations are, you want to draft the deal terms. So on your own, you can decide what is reasonable for you for selling your business. You need to make choices like, do you want to still be involved after the sale? Do you still want to be a partial owner of the business? Do you want to help train the next owner? You have to figure out what your goals are, and if you want to cleanly step away the business or be partly involved as an operator or just a financial owner of the business. So once you've kind of decided what the deal terms are and what you're looking for, you need to think a little bit about the structure, whether you're just selling them the assets of your company, like the intellectual property, or you're selling them the actual equity in your entire business. You have ideas now on what you're actually trying to sell, what is going to happen when you sell the business, and how much you're going to sell it for. What is important now is the final phase, which is due diligence and closing. As soon as you have a buyer who has an offer that's within the valuation range that you've calculated and is acceptable to you to sell your business, you're going to want to move forward with due diligence. So the buyer or the investor is going to reach out with a diligence request list. It's going to be asking for a bunch of information about your business, focused on the financial and legal components of it. Primarily, they want to really know how your revenue is broken down between your different products. They want to know how many customers you have and how that's changing on a monthly basis. They want to understand how fast your business is growing, or if any parts of it have been slowing down. And they also want to understand how well your intellectual property is defended. As you're sharing this information with them, they're going to be requesting information with you, and then they're also going to want to get on calls with you every week to talk about the documents that you're sending over to them. So on the technical, legal, and financial side, all these three aspects are going to get validated. It's very common during due diligence that a buyer will loop in an attorney or an accountant to take a look at the legal and financial aspects of your business. They primarily are just trying to confirm that your business is exactly what you say it is. So once you get through all of this due diligence process and all that stuff's cleaned up, it can take about a month if a buyer is moving pretty quickly. But if you don't have all your data put together and it's a little bit more of a sloppy process, it can take 2 to 3 months, sometimes more. Once all that's wrapped up, the buyer is going to start to draft a purchase agreement for your business. You want to think about if there's any last things that you need from the buyer, anything that you need to make sure is said, say it now, right? This final stage, they're going to be preparing this agreement, and you are going to be setting up your escrow account to receive the purchase price from the buyer. Now that everything is wrapped up, you've decided which buyer you want, the offer range is exactly what you're looking for, all the deal terms and the structure have been decided, you get to stay with the business or walk away, you've agreed with the buyer on everything that is going to occur. The final stage is that they send the money to an escrow account, and then the escrow agent disperses the money to you. Once you've done that, congratulations, you have sold and successfully exited your software business. So if you're looking for help with this process, grab the link in bio. I have this whole guide, the whole valuation calculator. All this stuff is for you guys to use for free all you need to do is follow the steps here.